Hi, everyone. Good to be with you all again. Thanks for joining. I'm going to take the next 12 slides. It's been a complicated year and try to highlight a few things that we're thinking about, maybe a little bit of what's already happened. For those who've been on these calls before, our standard slide looks at what's happened year to date in the different asset classes. A couple things to point out. Once again, the US S&P 500 and tech stocks are doing well. What's different this year is that the international stocks are doing meaningfully better than the S&P 500. So that's a change from like the last 5 years. What's also different is the aggregate bond index or the domestic bond aggregate up 7.5% in total return is one of the best years since rates started going up. Not much change in the 10-year treasury yields. I don't think there's much to highlight here. And again, no surprise really on the year to date, the performance, the last section, technology doing the best, and the defensive sectors like consumer staples doing the worst because this is a very bullish market that growth stocks are still doing well. And we'll talk about some of those aspects in the coming slides. Oh, just the same asset classes. I've added gold and Bitcoin here. If you're on a small screen, the line that's at the very top, that's gold. That's up over 50% year to date, followed by emerging markets, international, developed, tech stocks, and down to small caps and aggregate bond index. What's interesting is from when we last spoke, Bitcoin has given back a lot of the gains and again speaks to the volatility and why you need to be careful about the position sizing of this asset and take a longer term view. I'll have more to say. The next few slides, I'm just going to talk about the economy. The US economy is over 70% consumer or consumption led. So I think it's important to think about, look at this data and the factors that impact the consumer. Overall, as you've read or heard, the consumer is doing fine, or consumption is doing fine, actually. I should change that. And these two slides, I keep harping on one of the metrics, which is TSA checkpoint throughput. So these are flyers. The black line is 2025. It is doing fine. It's not up a lot. It's kind of in line with 2024, but these are volume numbers. You think about the price increases, people are consuming more year on year. And, you would likely see the same thing on the airline share prices and their results. Just keep in mind, it's the top echelons of the income pie that do the flying. The bar chart on the right is seated dinners. This is a stat that's released by OpenTable if you guys use the booking app. It's higher end restaurants that tend to be on OpenTable. It's not the lower end table. So, that's up over 10% year on year. These are both, reasonably, at least fine to robust numbers. And it just speaks to the robustness at the upper end of the income spectrum and the consumption spectrum. And, we constantly hear about the K-shaped economy. What's not doing so well is the lower end. Here, I'm just looking at stats on cars. The bar chart, car repossessions, back up to the highs we saw in the global financial crisis in 2008 and 9. On the line chart is auto delinquencies. This actually, unfortunately, this chart does not go back to 2008. If you did go back to 2008, the numbers are even higher. It's, the 2008 was a lower delinquency rate. What's more interesting to me, and kind of speaks to the earlier slide, the prime consumer. So these are these lower, the lower two charts. You're not seeing a deterioration, right? So again, the high income consumer doing fine. The deterioration has come almost entirely, not almost, has come entirely from the subprime sector. And so speaks to the K-shaped recovery. And there's a segment of the population that is not doing well despite where the asset prices are or a decent economy. Other areas that you've seen, consumer sentiment, and talking about the University of Michigan survey, is nearly at an all-time low. This chart just looks at a subcomponent, which is the expected change in unemployment. And that again is at a very high level. The red shades or the red markers are when we saw recessions in the past, when this indicator was, up at these levels. What I would say is, given how polarized the US has become, that there is a wide divergence between how Democrats are saying, surveying or responding to these surveys versus Republicans. And an estimated 30 to 40% of these respondents, almost everything is now done online, especially after COVID. 30 to 40% of the survey respondents are bots, automated bots. So there's a question of, it's an open question. I don't have the answer. I don't think anyone does, whether the signal you get from these surveys are no longer as valid as they were in the past. So I just leave it out there as an open question. We've heard that job growth is slowing. Yes, it's slowed. What's interesting is, if you look at this, if you pull the stats apart, really all of the slowdown has come from the government sector. I mean, it is not normal to have the government sector be the vibrant sector where it's hiring. And since 2023, the private hiring has actually been pretty stable. It's up about 1% year on year, and the government hiring has come down. And presumably, no one should be surprised given kind of the goals of the current administration. So that's something to keep in mind, that the private hiring continues to be fine. It's not, robust, but it's probably a good thing that it's not really high, because with the lack of immigration and just demographics that have been underway for many years now, the overall growth in the pool of applicants or working age population is estimated to be flat to even negative now. So you don't want to have a ton of jobs going with no growth in the labor pool, because that's going to lead to inflation, and that's not something that's good for most asset prices. I have a kid in college, so I'm particularly sensitive to the question about AI and job growth and job losses. The headlines are, oh man, AI is going to ruin the job market, particularly for kind of entry-level white-collar jobs. This is a great chart from a Bloomberg article that I picked up. If you thought that was the case, then the sectors with the highest exposure should be seeing the highest increase in job losses, or unemployment in this case. And then the sector with the lowest exposure should have the least impact in terms of unemployment. What their study shows is that the sector with the highest and the lowest, so it's the dark blue and the light blue lines at the very top, have both seen an increase in unemployment, which goes, I guess the simple conclusion is that there's no conclusive evidence that AI for the moment is having an impact on unemployment or job creation. And so, something to be watched. And I would also say, most of the jobs are created by small businesses. So when you read and hear, oh, Amazon's laying on X number, that is great for the narrative, and it's like, oh, shock effect, because that's what the media highlights. But really, that's not where the bulk of the jobs are created. It's created in the small business space. Switching slightly to looking at the market. You've heard over the last few webinars that we've done, or when I presented, this US stock market is expensive. I particularly like this slide because there should be some correlation between the value of US companies and the US GDP. And this is kind of a, I would say, outright worrying sign. And this looks at the 10 largest stocks in the US. And in 2000, at the dot-com bubble, the value of the 10 largest companies was 28% of GDP. Today, the value of the 10 largest companies is 76% of GDP. This is not a timing tool. This level of valuation can go on for years, but it's certainly something that anyone with common sense would go, yeah, this kind of, should be worrying. And, I put another thing where it's like NVIDIA's market cap is bigger than all the listed banks in the G7, like the largest 7 economies of the world. So there are quite a few stats. And to Alex's point, and I'll highlight on this or flag this more in the upcoming slides, you just want to be, the only thing we can do is, since timing is uncertain, just to be sensible about your asset allocation and not be overexposed to potential pullbacks. I showed this in the second half, the first half slide deck as well. Goldman Sachs has a index of unprofitable tech companies. These things are doing extremely well. This is not something you see when, markets, you see it when there's excess exuberant. It is not back up the 2001 levels, but it's certainly picking up higher at the moment. So again, another sign of the current environment that we're in. This is a chart, a longer term chart, looking at this current rally going back to the lows of 2009, the bottom of the GFC. It's this blackish grayish line. And what it says is, it looks extended relative to past cycles. And this is going back about 120 years. My caveat is that, yeah, it's been going for 17 years, but this is not a statistically significant sample. There are two other samples or two other periods where it's gone beyond where we are. And that you can't look at those just two data points and say, oh, look, this current cycle is also going to, reach a top reasonably soon. So yes, there are signs that valuations are expensive in relation to absolute terms, in relation to GDP, and it's extended. So it's this matrix we're always trying to figure out, how we position portfolios as thinking about funding retirement incomes for decades to come. This is another slide I've shown. One thing here I would the S&P 500 is this orange line. So it's, but you're paying about 26 times earnings, meaning if earnings from the index is $1, you're paying $26 for it. It is clearly elevated. It's back up to where it was during the dot-com bubble, where not as high as what it was in 2021, but we're getting up there. What's more interesting, and I've said this previously, not every company in the S&P is overvalued. And the blue line shows you the valuation of all of the companies if they were weighted equally. And that is very much within the range of what we had over the last 15 years, where it's traded at 18 times earnings. So that's an area where I continue to focus on, where this you can allocate to the more of the S&P stocks that are not expensive, and many of them happen to be pretty good dividend payers as well, which is something that Alex was highlighting. One last thing in terms of assets, I think I've been highlighting gold as a potential hedge. We saw in April, when the markets fell off very sharply on the tariff news, gold was really the only hedge, because even bonds, which typically go up when stock markets go down, didn't give you any protection. Gold has done incredibly well, and for many visuals and metrics, I could easily make the case that gold is in a bubble. You really have to think, if you're allocating incrementally to gold, you got to think that there is a regime shift underway, as we saw in 1970, where inflation picked up. I would argue we do have a regime shift in global geopolitics, but the message would be do not be surprised by sharp pullbacks. Like 20 to 30% pullbacks could easily be possible given how much money has gone into this asset class. So you want to be careful about position sizing your exposure so you don't get shaken out at the wrong time and potentially be able to even add to this asset at a lower level. I want to highlight, I talk about some more esoteric assets. My clients tend to be younger than Alex's clients, so I have, the ability to get into more, I guess, aggressive allocations. So I just want to make that point. And I'm really going to end on this one slide. Conclusions and the ideas that we have. I think the main overall takeaway I would have is there are plenty of signs that we are at higher, arguably riskier levels for US stocks. And so, as we saw in April, the pullbacks tend to be very strong. And therefore, you want to have the flexibility to act proactively when those pullbacks happen. And if you think it's an opportunity to, add to positions. One of the areas that I'm focusing on for 2026 is, we are cutting rates now into a relatively healthy economy. That doesn't usually happen. Along with higher deficits, does that make CPI or inflation a factor, a risk factor when CPI goes up? I think that is a risk. It is not a risk on a 3 to 6 month view. It is more of a 12 to 24 month view. And the main benchmark or the line in the sand I'll be looking at is property prices, because property prices have slowed down. The impact on CPI is that it's stabilized as a result. But if we cut rates, mortgage rates go down, availability goes up, and property prices start going up again. So that would be one of the key risks that I look for. On the stock side, given how well international has done, it's actually increased as an allocation for client portfolios. We would continue to maintain it. I think many of the slides have already kind of articulated my worry about this huge exposure to the 10 stocks, which are now about 40% of the S&P. So I would say, as you have opportunity, you want to rebalance. As Alex said, we've done it about 3 times this year. One was a proactive rebalance where we were able to rebalance at the beginning down out of some of the winners, and then in April add back, and that's worked out pretty well. We continue to remain cautious about small and mid cap in the US because that is the area that's most exposed to a slowdown or a recession. Because of this uncertainty about inflation and a slowdown or a recession, as I say, for fixed income, we continue to believe in some value in owning TIPS, Treasury inflation protected securities, and some intermediate securities. Given the level of debt, we do not really like the idea of owning long-term bonds, because that's where people, when countries and investors don't want to fund the US, the $2 trillion of new debt that we issue every year, that's an area that might be impacted the most. Credit spreads, meaning how much more interest you get for buying junk bonds, it's near a historic low. So we don't really like the risk reward there either. 2 last things: high deficits, worsening geopolitics. Consider gold and Bitcoin as strategic hedges, but really important to take a long-term view and position size, because these are assets. Bitcoin has been incredibly volatile throughout its short history. Gold, given how much has gone up, has the potential to be quite volatile as well. And to reiterate, maintain the capacity to add to market pullbacks and be proactive in sticking with your plan and risk managing your portfolio.